This week on Wealth Track, as investors dump stocks, two great value investors are loading up. Davis Fund's Chris Davis and Wintergreen Fund's David Winters are sifting through the rubble and finding many high-quality gems. Great investors Chris Davis and David Winters are next on Consuelo Mack Wealth Track.
The company you keep is also the company we keep. Together, we help provide a lifetime of guaranteed income and investment solutions.
Hello, I'm Consuelo Mack. I want to tell you about a new opportunity to watch Consuelo Mack Wealth Track before the program appears on public television. As a subscriber, you can see programs 48 hours in advance of the general public and also find timely interviews and commentaries exclusive to Wealth Track Premium subscribers. If you're interested, just go to wealthtrack.com for more information. Thank you. Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. Two of the major investment trends we are monitoring regularly on Wealth Track have become more pronounced. They are related and they have the potential to hurt investors over the long term. Our goal in today's show is to put them into perspective and help you deal with them with the help of two seasoned value investors, the Davis Fund's Chris Davis and Wintergreen Fund's David Winters. One is market volatility. The other is how investors are reacting to it. Now, we all know the story of heightened market volatility, the big swings we've experienced in the stock markets at various times this year. 3 to 4% moves in a single trading session and double-digit swings in matters of weeks and months have rivaled those during the 1987 crash and the worst of the financial crisis. All very unsettling to investors. And investors are reacting accordingly. They are fleeing the stock market in droves. As this chart from independent research firm Bianco Research illustrates, net new outflows from domestic equity funds, essentially the difference between investments in and redemptions from the funds, increased dramatically during the financial crisis of 2008 and 2009. And after a brief pause, have accelerated again since last year. Some analysts believe with 2 months to go, U.S. stock mutual fund outflows are on track to surpass the record set in 2008 and the near-record outflows of last year. Why could this stock exodus hurt investors? Well, our two great investor guests believe the value to be found in high-quality global brand-name company stocks has rarely been better. Chris Davis is a third-generation value investor at the Davis Funds, which earns the highest marks for shareholder stewardship from Morningstar. Chris is co-manager of the family's flagship New York Venture Fund, among others. New York Venture has an excellent long-term track record. It is the only mutual fund to outperform the market in every 10-year period since 1970. But like several other top value-oriented funds, has been underperforming its peers and the market of late. Such is not the case with David Winters, founder of the 5-star rated Wintergreen Fund. Winters is a longtime global value investor who launched Wintergreen 6 years ago as a go-anywhere, invest-in-anything fund. He has done just that and has beaten the market and competition by a wide margin during this difficult period, which is why we are delighted to have his firm Wintergreen Advisors as a sponsor and David as a guest. I began the interview by asking Davis and Winters why they feel this is the wrong time to flee stocks.
I think one of the peculiar things about stocks is it's about the only thing on earth where the lower the price goes, the less people want it. So here we are after a decade of falling prices and rising profits, and now people want to get out of stocks, and worse, they want to get into what's already gone up where prices are high, which is things like bonds and
treasuries.
Treasuries. Right. And so, if you think about a pizzeria that earns $100,000 a year, if you could buy it for $2 million, your return would be 5%. If you could buy the same business at $1 million, your return would be 10%. So lower prices increase future returns. It's as simple as that. So here we have lower prices, higher corporate profits, and now people want to get out of stocks simply because the prices are down.
just because prices are down doesn't mean they're going to go up. And so what kind of returns, number one, do you think we're going to get from stocks in the future, or the kinds of stocks that you are buying in the Davis Fund's New York Venture, for instance? And when do you think the market is actually going to pay off? Because it hasn't paid off if you bought the S&P 500, certainly for the last 10 years.
Well, I don't know when. In this sense, it's always unpredictable what the market will do in the next 6 months, the next year, even the next 2 years. But if you focus on the underlying businesses and you think of your return being based on the earnings the business generates. So right now you could buy the S&P 500 or a representative portfolio of really high-grade durable companies, and you would get about an 8% earnings yield and about a 3% dividend yield. So when you think about returns, the best place to start is the returns of the business. Over time, the stock prices can gyrate up and down, but the returns that you should get as a sort of a benchmark starting point should be based on the earnings yield of the underlying businesses over time.
All right. All right, so for the defense for stocks, so David Winters, why do you think it's a big mistake for individual investors to be fleeing stocks in droves at this particular moment?
Well, first of all, I agree with everything Chris has said, and I think you're right. But I think what's also...
That makes me feel much better.
but I think the key thing is that a lot of companies, their underlying earnings are growing at a rapid clip. And today, people don't factor in a bright future. People basically think the world is going to end or it's going to do nothing. And the tone is so gloomy.